Okay, let's unpack this. Today, we are diving deep into the world of the Japanese general trading companies, the Sogo Shosha.
Mm.
But our focus is on what I think is the industry's true outlier, Itochu Corporation.
It's such an essential deep dive because when most people hear Sogo Shosha, they immediately think of massive global resource projects.
Oil, gas, iron ore, that sort of thing.
Exactly. These firms are so often defined by commodity cycles. But ITSCHU, oh, they've consistently achieved top-tier financial performance, and they're seen as a leader in corporate governance,
Yeah, with recognition from S&P Global, the GPIF.
all while pursuing a fundamentally different business model. It's a fascinating story.
It really is. So our mission today is to get into their strategic sources, their filings, reports, management statements, and find that counterintuitive logic.
Up the why.
Exactly. We need to explain the success of this merchant type, Sogo Shosha. How does a company focused on consumer goods and retail manage to consistently outperform its resource-heavy peers? What's the hidden business logic?
I think the logic is really embedded in their DNA. While other shosha have a huge percentage of their earnings tied to resource trading, ITOCU's segmented business shows a massive non-resource ratio,
Something like 75%. Yeah.
around 75%. Their focus is overwhelmingly on consumption, downstream operations, and, the life cycle of the average customer, not the production cycle of a mine.
And that identity goes way back. Over 160 years, their core operational anchor is the Sampo Yoshi philosophy.
Right.
And this isn't just some historical anecdote they put on the website. It seems to be a central driving principle.
Yeah.
Good for the seller, good for the buyer.
And, crucially, good for society. That three-way goodness translates directly into their modern structure.
So how does that look today?
Well, they operate across 8 major division companies.
Okay.
It covers everything from textiles and food to machinery and finance. But what's really fascinating is the creation of the 8th company.
That's the newer one.
It is. It's not a traditional segment. Think of it more as a cross-segment accelerator designed specifically to leverage their expertise in lifestyle and consumption.
Driving that good for the buyer part into new profitable ventures.
Exactly.
To make a model like that work, you'd need incredibly disciplined operations. And that brings us to their famous management philosophy. Low center of gravity management. Low Jushin-K.
Mhm.
Now, this can sound like vague corporate jargon. What does it actually mean in practice?
It's anything but vague, actually.
Mhm.
It's about building in structural resilience and maximizing efficiency. I mean, think of it this way. If traditional resource giants are like massive tankers built high up and susceptible to huge waves,
Right, the commodity price swings.
IGSCHU aims to be more like a lean, low-profile speedboat. It's about minimizing unnecessary overhead, strictly managing costs. That's the cut part of their earn, cut, defend motto,
Yeah.
and being really smart about personnel.
So they avoid those painful forced layoffs later.
Exactly. They operate leanly, more like a high-margin specialty retailer than a typical resource giant with massive fixed global infrastructure.
That intense focus on efficiency has led to one of the most talked about cultural changes in corporate Japan.
Oh, yeah. The working style reform.
Specifically, the morning shift culture,
Right.
sometimes called the 110 movement. Why is this so famous?
Well, it's famous because it directly tackles a deeply ingrained challenge in Japanese corporate culture. Long working hours, staying late.
The late night office culture.
Right. The 110 movement incentivized starting work early, often between 5 a.m. and 8 a.m., and then leaving shortly after 3 p.m. It prohibits late-night work except in really rare circumstances.
And the impact.
Financially, it slashed overtime costs.
Yeah.
But strategically, it drove this cultural shift that just demanded higher productivity during core hours while also safeguarding employee health. It really reinforces that low Jushin efficiency.
So we have this 19th century philosophy and 21st century operational rigor just hardwired into their structure. How's that translated to the bottom line recently?
Exceptionally well, even with all the global uncertainty. If you look at their trajectory, their last midterm strategy, the Brand New Deal 2020, was all about downstream plays.
Things like next generation commerce.
Right. And this continuous people-focused approach has delivered results.
Where recent numbers definitely confirm it. For fiscal year 2024, they posted a consolidated net profit of $880.3 billion, a new record high.
And here's the key insight, I think. Looking ahead to FY 2025, they've set a profit target of $900 billion.
Which is aggressive.
It is. But what's really material is why it's so impressive. Management established this target despite explicitly factoring in significant external risks. They baked in a potential 5% slowdown risk.
Frame what?
Geopolitical sentiment, economic uncertainty, even the unpredictability of, say, Trump-era trade policies.
That is fascinating. What does that tell us about the structural difference between ITOCHU and a firm that's, heavily exposed to the price of oil?
It's all about stability. When commodity prices collapse, resource giants see these massive rapid profit erosions. But because ITOCHU deals in stable consumer transactions, food, finance, retail, their earning stream is just more resilient.
So setting that record target while planning for a storm shows a lot of confidence.
It shows profound confidence in the shock absorption capacity of their non-resource model. They believe their cash flow is predictable enough to weather that external volatility.
And they're backing that confidence with serious capital. They've got this central principle for growth. No growth without investment.
And they're planning to execute up to $1 trillion in growth investment between 2024 and 2025.
And where is that capital going?
Overwhelmingly, it's directed toward reinforcing their core merchant advantage, that downstream customer-facing business model. They're actively looking for M&A and strategic alliances that solidify market share and operational control.
Not just hunting for resource concessions.
Not at all.
Speaking of strategic alliances, let's turn to their global footprint. North America seems to be a key focus, with integrated moves in machinery and energy.
North America is critical for them. In machinery, they're moving way beyond just facilitating trade. They've got capital tie-ups with domestic giants like Kawasaki Motors.
Right, the power sports segment.
Exactly. Motorcycles, jet skis, off-road vehicles. This move integrates ITOCHU right into the high-margin retail finance side of the business.
And they're also locking down their industrial value chain, right? The acquisition of Itochu Corporation.
A leading aerial work platform producer.
Yep.
The goal there is to consolidate their domestic base and then use that strength to push the business overseas. They're converting trading relationships into deep operational management control.
So if we connect this to the bigger picture, the strategy seems to be capitalizing on these huge, non-commodity macroeconomic trends.
Absolutely. Look at energy and infrastructure. They're actively setting up renewable energy funds across North America. And this move is explicitly positioned to capture the exponential increase in U.S. power demand.
Driven by the enormous appetite of AI data centers.
You got it. It links their information and energy segments perfectly.
Okay, now let's switch over to Asia. We know they have a massive presence there with ITOCHU China Group and their investment in See It Limited. What's the status of that portfolio?
Well, the China presence is still strategic, but the sources show some recent volatility. For instance, profit contribution from investments like Ciatic has actually decreased.
Why is that?
Rising U.S. interest rates and revaluation impacts. So it highlights that even though they are non-resource heavy, they are not immune to macroeconomic shifts and currency exposure.
And that's where the yen comes in. When the U.S. dollar is strong, their resource-heavy competitors often get a big boost from translation gains on dollar-denominated assets.
They do. And ITOCHU's global strategy exposes them to those currency shifts too. But as we said, their deep non-resource base provides a buffer against the commodity crash scenario.
So they're trading potential windfalls for reliability.
Precisely. They've chosen a stable earnings trajectory over a volatile one. And that stability is ultimately built on their operational businesses, which is why we need to spend some serious time on their key competitive moats.
Okay, let's do it. Let's dive into the core mechanisms driving their future growth. The first, and maybe most visible, is their retail data moat. And it all centers on Family Mart.
Right. Family Mart, or FM, is fully owned. It operates as the group's single largest consumer touchpoint. It's the engine for that market-in approach and sits right at the heart of the eighth company.
So they're not treating it as just a convenience store chain anymore.
Not at all. They've realized the real estate is merely the platform for the data.
And one big success story is that digital signage network inside the FM stores. The sources show a, 60% viewing rate among customers?
A remarkable 60%. That's transforming physical retail into a high-margin media business.
But they're extending that data advantage beyond their own four walls, aren't they?
They are. The collaboration with PPIH Group, that's the parent company of Don Quixote and Data One, is crucial here. By pooling customer data, they're creating a network with over 30 million advertising IDs in 100,000 item categories.
So they're building a proprietary network to rival the big digital platforms, at least in the domestic retail media space.
That's the goal.
It's interesting they're betting so heavily on this. I mean, aren't they just playing catch-up to what Amazon and Walmart mastered years ago in the West? Where's the unique moat?
The moat is the physical penetration and the integration within the incredibly dense Japanese market. And it's combined with their hand-on control over the financial and logistics aspects of the whole operation. This isn't just a theory either.
There are hard targets.
Exactly. They're explicitly targeting an incremental $5 billion to $10 billion in consolidated net profit by 2025 from these businesses alone.
Advertising, media, and finance.
Yep, that's a huge quantifiable contribution from just converting physical retail data into a digital advertising stream.
Let's move to the second driver. Their hands-on M&A integration strategy, the PMI moat. This is where that low junior philosophy really meets capital allocation.
It is. They don't just buy minority stakes, they buy full control and they force transformation.
Their competitive edge really seems to be in the depth of their post-merger integration.
It is. They fully acquired and privatized key growth engines like CTC, an IT solutions provider, and Daikin Kogyo, the domestic leader in wood products.
And the reason for taking them private was speed.
Speed and focus. It was explicitly to accelerate high-risk, high-reward growth strategies like capitalizing on DX and AI demand at CTC, or expanding Daikin's North American business away from the quarterly scrutiny of public markets.
The intensity of this hands-on approach is probably best illustrated by the WeCars incident.
Oh, absolutely. After that high-profile governance scandal at WeCars, which used to be Big Motor, Itochu dispatched over 70 staff to completely rebuild governance and public trust.
70 people.
70. That's not just governance oversight. That is an operational takeover and remediation. It sends a powerful signal to the market.
That when ITSCHU commits capital, they commit human capital and take full responsibility for the management quality.
You got it.
That makes sense. So the hidden logic seems to be diversification coupled with that management depth. The sources show they have this large layer of small to mid-sized companies.
That's the key to their resilience. 148 companies generating under $2 billion in profit. This large, diversified base, coupled with intense hands-on management that actively sweats the assets, ensures a high CGR across the portfolio.
Even if one or two segments hit a roadblock.
Right. They're actively improving 148 smaller companies rather than just passively holding a few big resource stakes.
Okay, driver number 3, the accelerating corporate transformation, or CXO, driven by AI.
Yes, they're actively restructuring their leadership to keep pace with generative AI.
So they've retired the traditional CDO and CIO roles.
And created the new CXO, the Chief Transformation Officer, in 2024. This change reflects the need for speed. They recognize that Gen AI is moving too fast for traditional, siloed digital governance.
And they're putting that transformation to work immediately. They're integrating a custom Gen AI iColleague with their own data platforms like Hanabi and DMP.
This is critical. They're not just trying to pinch pennies with AI anymore. They're moving beyond simple efficiency gains, the cut focus.
Right.
They're explicitly telling investors they want AI to open up entirely new business models and revenue streams, particularly in customer-facing sectors. That's the earn component.
The fusion of their retail data from Family Mart with this internal AI engine.
That's what's designed to create sustained, profitable growth.
Let's finalize the financial picture then. How does all this performance translate to shareholder value? What does their return policy look like?
It's defined by what they call the three balances principle: balancing growth investment, shareholder return, and strict control of debt.
Specifically targeting a net debt-to-equity ratio below 0.6x.
Which ensures the stability you need for predictable returns.
And they are committed to steady, real value increases. They hit a record-high dividend of $160 per share in 2023.
And their new medium-term policy is really attractive and transparent. Dividends will be set at the higher of either a 30% payout ratio or a floor of $200 per share.
A floor? That's a strong commitment.
It is. And on top of that, they're targeting about $150 billion in total share buybacks.
You know, from an investor communication standpoint, what really stands out is the quantitative clarity from the CFO.
You mean the financial matrix model?
Huh.
It's basically a transparent equation.
Right.
It explicitly communicates that to sustain a 15% or higher ROE while maintaining their dividend policy, they have to achieve a consistent 10% profit growth rate every year.
So it's a self-imposed quantitative hurdle. It forces management to perform and gives clear metrics to the market.
No ambiguity.
So if we pull all these threads together, what is the single most important variable defining ITOCHU's outlook for the next few years?
I think their next stage of growth really hinges on whether the tight, hands-on integration of those newly privatized companies, CTC and Daikin, and the successful scaling of the Family Mart retail media platform
Generate enough growth.
to sustain that self-imposed 10% profit growth hurdle, regardless of global economic headwinds. They've made a clear choice to rely on their own operational skill rather than commodity cycles.
That reliance on management intensity is clearly their competitive advantage, but it rests so heavily on their people.
Indeed. And ITOCHU believes its primary competitive edge is rooted in that human capital, the quality of its people. This is reinforced by aggressive cultural policies, like mandatory male paternity leave.
Where participation jumped from, 53% to 96% in a single year?
In 1 year. And they're doing the same with aggressive female executive recruitment targets. So the question for you, the learner, is this. Can the 19th century spirit of Sampo Yoshi and low center of gravity management successfully create a sustainable, high-growth competitive moat in the 21st century world of hyperscale AI and digital retail? That tension between tradition and technology will define their next decade.